Hey everyone, welcome back to Corporate Decoder, the place where we try to turn dense corporate filings into something understandable. And today we're diving into the DoubleLine Opportunistic Credit Fund's latest report, a treasure trove of financial data for folks interested in credit markets. Let's dive right in. This report covers the period ending the 30th of September 2025, and it gives us a real look under the hood of how this fund operates and performs. This fund aims to provide a good level of current income and a shot at growing its value. Think of it as trying to get steady earnings from investments while also hoping those investments grow in worth over time. They are investing in all sorts of debt and income producing assets. Big picture, their strategy is to invest at least 80% of their assets in debt securities, loans, and other things related to credit. Looking at their investments, a big chunk, over 27%, is in non-agency commercial mortgage-backed obligations. These are mortgage-backed securities that are not guaranteed by the US government. This means they carry a bit more risk but potentially higher rewards. Then we see about 19.5% in US government and agency mortgage-backed obligations. These are generally considered safer, backed by government entities. Following that is about 19.2% in collateralized loan obligations or CLOs. These are essentially pools of loans packaged together and sold as securities. Now let's talk numbers. As of the 30th of September 2025, the fund reported total assets of over $330 million, but also liabilities of nearly $30 million. This leverage means they are borrowing money to invest more, which can boost returns, but also magnify losses. Their net assets, the true value of the fund for shareholders, stand at just over $300 million. Their investment income for the year was strong, with over $23 million coming from interest alone. That is the bread and butter for a credit fund like this. On the expense side, they paid out over $3.2 million in investment advisory fees to DoubleLine Capital LP. That is part of staying afloat in the investment world, but it does eat into returns. When it comes to actual gains and losses on their investments, they saw a net realized loss of over $6.4 million. That is definitely something to note. However, their unrealized appreciation added over $9.2 million. This means while they sold some investments at a loss, the value of other holdings went up on paper. All in all, the fund saw a net increase in net assets from operations of over $20 million for the year. Pretty good, but remember those sales losses. Looking at the financial highlights, the net investment income per S-share was 94 cents for 2025, a decent bump up from the previous year. And their total return on net asset value was 7.30% for the year. That means if you held your shares, your investment grew by over 7%. That sounds good, but let's see how it stacks up. They outperformed their benchmark, the Bloomberg US Aggregate Bond Index, which returned 2.88%. So they did better than the market average for this type of investment, which is always a positive sign. Now, risks for a fund like this, risks are a big deal. They are heavily into things like mortgage-backed securities, which can be unpredictable. They also talk about credit risk, meaning the risk that the people or companies they lent money to might not pay it back. This is a major concern given they are focused on credit. And of course, leverage. The report explicitly mentions leverage risk warning that using borrowed money can boost returns but also amplify losses. They are using borrowings, reverse repurchase agreements, and potentially other forms of leverage, which makes them more vulnerable to market swings. Interestingly, in their proxy voting policy, they consider a case-by-case approach for contested elections, looking at management track records and financial performance. And they generally vote against proposals that limit shareholder rights or impose supermajority voting requirements, unless there are specific justifications. Their investment advisor, DoubleLine Capital LP, is paid a management fee of 1.00% of their total managed assets. This is a standard fee, but it is important to remember these fees impact your ultimate returns. Now, let's zoom out and look at this more broadly. The DoubleLine Opportunistic Credit Fund is clearly playing in a high-risk, potentially high reward space. They are investing heavily in mortgage-backed securities and CLOs, which are sensitive to economic ups and downs. Their performance outperforming the benchmark is a good sign, but the realized losses on investments and the heavy reliance on leverage are definite points of concern. They are navigating a complex market, and their strategy relies heavily on their ability to accurately assess credit risk and market movements. The fund's approach to proxy voting shows a leaning towards shareholder rights, which is a good governance signal, but the core of their business is managing credit risk in a world that is always unpredictable. So that is our look into the DoubleLine Opportunistic Credit Fund's latest report. What are your thoughts on their strategy and these numbers? Do you think their high-risk approach is worth it? Let me know in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description for more real-time discussions. Thanks for watching, and we'll see you in the next one.